if we step back from the most recent data, is a very clear recovery in employment since the recession ended about a year ago. And we see this in the unemployment rate coming down. It was at 10.1% back in October of 2009, and now it's down at 9.5%. Look, 9.5% is horrible, but the direction from where we were is what's important. That's really key. And that direction looks to be real. And it's actually remarkably happening fast compared to earlier recoveries. In the last couple of decades, it took a lot longer to get even that kind of directional change. The problem is we lost over 8 million jobs. So even if we're like, yay, we got 1 million jobs, so what? You still are way in the hole. That is why it doesn't feel good. The problem on top of that, compounding the fact that we're in this deep hole and we're trying to get out, is that the forward-looking indicators, the leading indicators of the business cycle, have been easing since the beginning of the year, pointing to a slowing in the economic activity itself. So jobs growth, GDP growth, sales growth, income growth, which has all had some recoveries, is now going to start easing off already. And we're not recovered yet, right? So that is why there's such an increased level of anxiety, and you're seeing that play out, for example, in the stock market and other markets. The size of the hole that we've dug in terms of the jobs losses requires an expansion that will last 7 or 8 years with no interruption in order to heal, to get those jobs back. That is highly unlikely. We are not going to have an expansion that long this time around. So the next recession will come before we've healed the jobs damage from this recession.